All right. Good morning, everybody. Today is January 12th, 2024. Happy Friday, everybody. And it's a hard choice to pick the top story this morning. So we're just going to go in no particular order. There's a lot of big ones happening today. First one, you probably heard by now. United States and UK launched multiple airstrikes against Houthi targets in Yemen yesterday. 73 airstrikes in total were launched against 60 targets. Participating in the raids, you had F-18s and E-18 Growlers from the Eisenhower Strike Group. That's the Navy jets that were involved. You also had U.S. destroyers, U.S. submarines getting in on the action, launching Tomahawk cruise missiles. You had UK fighters launched from Cyprus. I believe those are Eurofighter Typhoons. They flew all the way from Cyprus, refueling along the way. They participated, hitting targets all over Yemen. No casualty reports from the West that I'm hearing about. I'm hearing slight casualty reports from the Yemens, but it looks like they were not overwhelming numbers. Thankfully, not a lot of human losses here. It's mostly equipment and material that was blown up. Could have seen this one coming, guys. I tried to warn about this. Been covering the story in the Red Sea for weeks, and it was obvious it was getting here. This is a failure of leadership across the world, regardless of who did what and he did what and she started it. And no, that was there. Forget all that nonsense and that BS. There's plenty of a-holes who think they're fighting the war on Twitter right now with each other. This is a failure, a breakdown of leadership, a breakdown of politics on both sides. People, old men with no future, are sending young men to die on the battlefield, and it sucks. It is what it is, and we're all left to live with it. Oil prices are spiking as a result, and now the question is, what next? And the real wild card here is Iran. What does Iran do here? Do the Iranians retaliate because the Houthis are an Iranian proxy? They're using Iranian equipment. Do the Iranians get involved? Do they decide to get froggy in the Strait of Hormuz? And if you think oil prices are rocking right now, wait till you see what happens to oil if something similar starts happening in the Strait of Hormuz. Boy, oh boy, we have not seen anything like that since the 1980s. And it was a different world back then. So that's going on. We also got PPI, the Producer Price Index, just came out a few minutes before the show started. And PPI, well, totally different story than CPI and the higher than expected inflation we got yesterday. The Producer Price Index came in at 1% year over year. That's the headline number, and negative 0.1% month over month. So wholesale prices actually got a little bit cheaper in December, even though CPI said they got more expensive and at a faster rate. Core PPI, which strips out food and energy, core PPI came in at 1.8% year over year, so a little bit higher when you take out the food and energy. I guess energy was a big drag on the index last month. And then core PPI was 0.0% month over month. Now, this is 3 consecutive months of negative PPI headline numbers, and it is 3 consecutive months of unchanged core PPI numbers, 0.0 month over month. So PPI is telling us a totally different story about the inflation picture than CPI is. What gives here? And I was talking about this yesterday when we were going over CPI. I think it's the rent. I think that is the big difference here, because rent of a residence doesn't show up in PPI. And yesterday's inflation report, that hotter than expected, what was it, 3.4% CPI that we got yesterday, almost half of that was just increases in rent. And I was saying yesterday, the way we measure the rent in CPI, it just flat out sucks, guys. It is not an accurate data point. It's a flawed methodology. It doesn't reflect the reality. If you go look on the real estate websites and what you can actually rent a place for right now, it shows that in most local markets in the U.S., not all, but in most, asking rents have been falling for quite a while now. And they're probably going to fall a lot faster this year because you've got a lot of new multifamily residential, a lot of BTRs or build to rent houses that are hitting the market. There's new supply coming online. So the rent is driving the CPI higher artificially, causing everybody to say, oh, inflation is stickier, look over here, when really it was all just this one flawed statistic Meanwhile, the PPI is saying, guys, inflation, it's virtually non-existent. Headline PPI, 1% year over year. Now, again, guys, remember inflation is a rate of change. So no inflation doesn't mean prices going down. No inflation means prices stopped going up. Or disinflation means prices are going up slower. We don't have deflation. Prices are not falling for most things. But the headline PPI, negative 0.1, driven largely by energy prices. I'm guessing energy was down a little bit in December. Totally different story in inflation this morning. And stocks are liking it. As soon as PPI hit the tape this morning, all of the indexes started rising. So the market is taking back some of the losses from yesterday that were associated with the CPI. And we also got big bank earnings came in today. A lot of big bank earnings, trillions of dollars in market cap reporting here. Let's do the real quick, and then we'll go into the nitty gritty. JPM, awesome report. Basically, JPM just gobbled up all their little competitors last year, when they swooped into the rescue and said, you're welcome, buying up assets for pennies on the dollar real cheap when all the banks failed last year. Well, after eating that big Thanksgiving dinner of their smaller competitors, JPM just let out a big belch of record profits thanks to being a much bigger bank now. Net interest income hit a record for JP Morgan in this quarter. Bank of America, not so good. Bank of America posted some pretty lousy results, not terrible, just okay, but they missed expectations. A big charge associated with the transition from LIBOR to SOFR, LIBOR being the London Interbank Overnight Rate, and SOFR is the secured overnight funding rate that's run by the Fed. I'll be honest with you, a lot of that went over my head. It has to do with interest rate swaps and hedging and fancy accounting. I'm going to go ahead and take their word for it there, that's really what happened. But a big charge for Bank of America associated with that change. Wells Fargo had some pretty bad earnings. A big charge for severance costs with Wells Fargo that was largely telegraphed. We saw a lot of layoffs from Wells Fargo last year. That is proving to be very expensive for the bank, and it's hitting their earnings. Also, we're expecting more layoffs at Wells Fargo in 2024, so we'll probably see more of that. And Citi was just awful. Citi actually posted a loss, Citigroup, although it was slightly less of a loss than the market was fearing. We talked about that a little bit yesterday. So Citigroup stock is up a little bit, even though they just posted a terrible quarter. And all of those banks all posted big charges related to the FDIC special assessments. The FDIC is replenishing the deposit insurance fund after bailing out all the banks last March. And so now the big banks are having to pay these special one-time charges in order to replenish that insurance fund, because the big banks were the primary beneficiaries of those bailouts. And so they are being asked to pitch back in to make Uncle Sam whole. And of course, it's not like the big banks are being generous, because they're going to just pass that cost on to you in the form of higher ATM fees, higher interest rates, this and that. Trust me, guys, either way, it's coming out of you one way or another. So those are the big stories going on today. There is a ton of them. Let's shrink my big melon of a head and see what is going on in stocks and in bonds and everything else this morning. Don't forget that like button, guys, and hit the subscribe if you're new here. It really helps with the YouTube algorithm. And have your coffee with the melon heads every day. Right now, the S&P is positive, just barely up 1 point. I want to point out right here, a big gap up. That was around 8:30. That was right as the PPI hit. Stocks really like that PPI report. Looking at the Dow, we got something a little similar here. Big gap up right here. This was right around 8:30 when PPI hit. Currently, the Dow is down 73.9 points, negative 0.2% lower. So Dow not faring quite as well as the S&P. The Dow is being dragged more heavily by the banks, I think. And the NASDAQ is actually having a pretty good day here. Well, no, it just went red. Me and my big mouth. The NASDAQ is down 1 point, 0.01% lower. Again, big green candle up right here as soon as the PPI was hit. Market really liked that. DXY is currently positive. We've got a 102.33 on the Dixie. That is up 4 basis points this morning. Slightly stronger dollar. Although it was much stronger a few minutes ago, it gave back most of its gains, again, on the back of that PPI report. Lower than expected inflation means the possibility of a more dovish Federal Reserve, and so the dollar got a little bit weaker on that news, but still in positive territory for the day. Looking over at the bond market, we got a little bit of a mixed bag. We got some positive moves in the yield on the very long end of the curve. The 30-year Treasury is up 3 basis points, 4.211%. Meanwhile, the 10-year is unchanged at 3.978%. The 2-year is at 4.178. That's actually down 8 basis points. Look at that move in the 2-year. Not sure what's going on there. Big move lower in the 2, even though we got positivity in the 30-year here. And the 1 month is also positive, up 1 basis point. I'll be honest with you guys, I'm not sure what the market sees happening 2 years from now, but all of a sudden we've got a big move in the 2-year happening. Put a pin in that. That might be worth looking into a little later. Also on reverse repo watch, guys, we have got reverse repos at $626 billion, a drop of $53 billion yesterday. So we took a step change down. It wasn't a huge change down, but that is a new low for the reverse repo. We are still above this trend line that has us running low pretty much the end of March now. Or I'm sorry, the beginning of March now. It's been drifting a little bit. It shows a little bit of indicator that, hey, maybe this thing is starting to slow down here. I don't know if you guys can kind of see this leveling off a little bit. I'm not sure if that's actually leveling off or if we're just going to get slammed down again in a couple of days here. But we're going to keep an eye on that one. Again, as this gets closer to zero, the odds of a liquidity event do go up. But it doesn't mean all hell breaks loose on day one when we get to zero. It just means something elsewhere starts to get stressed and strained and liquidity does get tighter. But this is not going to be, the buzzer goes off and then everybody freaks out. That's not what's going to happen. But this is definitely something that is worth keeping an eye on. Looking over at the commodities board, we have got gold. Wow, gold is a lot higher this morning. $2,058 for February gold futures. That's up almost $40 this morning. 1.96% higher for gold. Flight to safety going on here, guys. Probably a lot going on with the situation in the Middle East has people going for the safe haven asset. Silver, March silver futures at 23.42. That's up 72 cents. 3.16% higher for silver. Congratulations, stackers, having a good day, although they need it because silver has not had a very good couple of weeks. Platinum and palladium are both up just under 2%. West Texas Intermediate crude oil futures for February, 73.84. That's up $1.82, 2.5% higher this morning. It was up as much as 4% this morning, but oil having a pretty good day here. Let's take a look at the oil chart. You can see a pretty big wick on top of this candle here because oil was much higher. It's given back a lot of those gains. But I just want to point out, guys, we've been bouncing around in this channel here, this descending level of resistance. We had a false breakout. We came back down below it. But if you notice, we came up, retested, and now it looks like we might be broken out of this channel, moving a little bit higher as the situation in the Middle East just gets worse and worse and worse. Right now, we've still got the threat of global slowdown in demand, of global trade slowing. The situation in the Red Sea is going to hurt global trade, but it's also going to hurt supply. So we've got this, supply disruptions versus demand destruction, which is going to be the more powerful force this year. For the last couple of months, demand destruction has won out big time, and oil prices are still pretty low. But the supply disruptions just keep getting worse here. I mean, the situation in the Middle East is not improving, not one bit. It keeps slowly getting worse. Iran is that big one. If that Strait of Hormuz hits, guys, then we won't even be talking about demand destruction anymore. We are going to be talking about big green candles to the upside if that happens. And right now, that is a lot more likely than it was yesterday. And here we go. U.S. and Britain strike Yemen in retaliation for Houthi attacks on shipping. U.S. says 60 targets were hit with more than 100 precision munitions. 4 oil tankers were diverted from the Red Sea. U.S. and British warships, warplanes, ships, and submarines launched dozens of airstrikes across Yemen overnight in retaliation against Iran-backed Houthi forces for attacks on Red Sea shipping, widening regional conflict stemming from Israel's war in Gaza. Witnesses confirmed explosions at military bases near airports in the capital of Sana'a and Yemen's third city of Taiz, a naval base at the main Red Sea port of, I don't know how to pronounce this, Hodeida. Sorry, guys. Pronunciation not my strong suit. And military sites in the coastal of Hajjah Governorate. I can't pronounce any of this stuff, but yeah, stuff blew up there. These targeted strikes are a clear message that the United States and our partners will not tolerate attacks on our personnel or allow hostile actors to imperil freedom of navigation, U.S. President Joe Biden said. Most likely Joe Biden's intern said that. The Houthis said 5 of their fighters had been killed in a total of 73 airstrikes and that they would retaliate and continue their attacks on shipping, which they describe as intended to support Palestinians against Israel. And it's not the Houthi retaliation, guys, that you need to be concerned with. It is, what do the Iranians do? The Houthis are going to do what the Houthis are going to do. But really, whether this thing escalates or not, it's up to the Iranians at this point. Ball's in your court, Iran. Yeah. So we got that going for us. Let's move over to the producer price index, guys. This one just hit the tape earlier today. Producer prices in the United States increased by 1% in December. That's over the same month in the previous year. Here we can see in the chart PPI. This is showing a pretty consistent decline, right? We came down all through early this year as the rate hikes took their toll. Had a little bit of bounce over the summer, but not much. And now we are up 1% year over year, slightly higher than the 0.8% that we had in November, but still a pretty clear downtrend going on here, guys, and well below that 2% target over at the Fed. Now, looking at the PPI month over month, again, not looking so good here, guys, or at least looking like lower inflation. Producer price inflation month over month in the United States remained unchanged at negative 0.1% in December. That sentence is a little confusing. It's been negative 0.1% for 2 consecutive months. So it's not unchanged. It's falling at the same rate. That's a little bit of a confusing sentence there. But if we look here, guys, at this chart, this is 3 consecutive months of negative reads in the producer price index. And the producer price index is the cost that is paid by the businesses to produce the products that you consume. So the PPI is heading lower. It's been heading lower for 3 months now. 3 consecutive months. And even before that, it looks like, what was that? September? No, that was August. We had a pretty high PPI. But it has been negative for the better part of the last year here, negative or just barely gaining. So PPI is telling us a totally different story than CPI. And it all boils down to the rent. The way we measure rent and CPI is BS. It caused inflation to look lower than it really was last year, and it's causing it to look higher than it really is this year. But the PPI is telling us something totally different. And then looking at core PPI, less food and energy, core producer prices in the U.S., which exclude energy and food goods, rose by 1.8% from the previous year in December, slowing from the 2% decrease observed in November and below market expectations of 1.9%. So again, core PPI, you see a trend, clear downtrend here, guys. It's been falling. It leveled out a little bit over the summer, and now it's fallen again, and we are below that Fed target of 2%. So core PPI, a little bit higher than headline PPI, but the trend on core PPI looks even better down and to the right. And then core PPI month over month in the U.S. remained unchanged at 0% in December. That is 3 consecutive months of no change month over month to core PPI. 0, 0, 0. A couple of goose eggs there. Guys, inflation in the PPI is coming down. Yesterday's higher than expected inflation report was a statistical error caused by the erroneous way that we collect data on rent. Inflation is coming down faster than we think, and the market sees that this morning, and it's liking it. But right now, the market may be focusing more on the bank earnings. JP Morgan posts record net interest income and predicts even more for this year. JPM made out like a bandit last year when all those tiny banks failed, and they came in and gobbled up all those assets for pennies on the dollar, and now they are reaping the whirlwind. JP Morgan Chase & Co. closed out the most profitable year in U.S. banking history with its 7th consecutive quarter of record net interest income and a surprise forecast that the windfall may continue this year. And hot damn, does that not tell you a perfect story of just how messed up 2023 was? A year that saw the 2nd, 3rd, and 4th largest bank failures in U.S. history all hit back to back to back. And yet JP Morgan, the biggest behemoth bank in the country, just reported the most profitable year in U.S. bank history. Maybe this is why CNBC keeps telling you everything is so good. Don't you understand how good you have it? What's the matter with you people? Look at JP Morgan. Meanwhile, the little guys are dead. Doesn't that tell you exactly what you need to know about the state of this economy? Net interest income, the difference between what banks earn on loans and pay out on deposits, came in at $24.2 billion in the final 3 months of the year, the company said in a statement. The haul for all of 2024 may rise to about $90 billion, according to the bank, while analysts had been expecting a 2% drop. A couple of noteworthy things here. Results from the biggest U.S. bank included a $2.9 billion charge tied to the failures of Silicon Valley and Signature Bank. So JPM, despite reporting this record revenue, they are writing a pretty hefty check to the Deposit Insurance Fund, but it's a smaller check than they're earning because of all of the assets that they gobbled up. The FDIC levied a special assessment to backstop uninsured depositors at those firms after they collapsed last year, and JPM warned that it would take the charge, which it previously estimated around $3 billion. Now, there was something else I wanted to note here. This quote from Jamie Dimon was interesting. Dimon said the need for increased government spending on the green economy. What need? We'll say the uncontrollable urge for these idiots to invest in projects that yield no return, which Jamie Dimon says is the need for increased government spending on the green economy. The military, got to have those wars, and the restructuring of global supply chains, i.e. our economic divorce from China. All of these things may lead inflation to be stickier and rates to be higher than markets expecting. Dimon is warning about a couple of big trends here, like, hey, we're blowing each other up. We're destroying our infrastructure for trade, our pipelines, our canals, our choke points. We're spending all this money on electric vehicles. How's that going, by the way? Got to love those AVs. Ask Hertz how they're liking those EVs. And so all this borrowing is going to send interest rates higher. It's not going to lead to any returns or any increases in productivity. So it's going to be wasteful. It's going to be inflationary. Dimon is warning about, in the future, higher inflation and higher interest rates. It's not a good warning there from Jamie Dimon, but that's getting lost in the magnificent numbers JPM just put up. JP Morgan is up 2.16% ahead of the opening bell, trading at 173.98. Now let's talk about Bank of America. Their shares fall after the company reports lower fourth quarter profit hit by a regulatory charge. There's that FDIC charge again hitting Bank of America here. Bank of America said its net income fell to $3.1 billion or 35 cents per share in the fourth quarter. That's down more than 50% from the $7.1 billion or 85 cents a share a year ago. So Bank of America seeing a big year-over-year decline. The bank, based in Charlotte, North Carolina, said it was hit by a pre-tax charge of $1.6 billion in the quarter related to the transition away from the London interbank offered rate that's onto the secured overnight funding rate. The results also included a special $2.1 billion fee charged by the FDIC. That fee is tied to the failures of Silicon Valley and Signature Bank. Excluding the items, the company said it earned 70 cents. So Bank of America is being hit by this weird interest rate swaps hedging positioning that they had associated with the transition from LIBOR to SOFR. It's interesting that this didn't hit any of the other banks there. I don't know if this is an unforced error by Bank of America or what's really happening there. And to be honest with you, the mechanics of this charge, I tried to look into it before we went live. I just didn't have enough time to get my head around it. Just going to have to take their word on that one. But one important thing with Bank of America I want to mention, the unrealized losses on their held-to-maturity assets, something we've been watching with Bank of America a lot lately, that is down big to $98 billion. The unrealized losses had hit a peak of $131.6 billion last quarter. But remember, guys, interest rates have been falling. Bill Ackman covered his bond short, and oh, yay, the big rally is stocks to the moon. Well, as interest rates have fallen, those unrealized losses on held-to-maturity assets at Bank of America have gotten smaller. So Bank of America, that's probably the biggest thing here. Yeah, the FDIC charges hit everybody, and this LIBOR SOFR thing was a little weird. But the hit from the higher interest rate got a lot smaller at Bank of America. And I don't think the market is really recognizing that one right now because at the moment, Bank of America stock is down 2.9%, trading at 32.19 ahead of the opening bell. Now let's talk about Wells Fargo. Their profit hit higher fourth quarter. They posted a higher fourth quarter profit helped by higher interest rates and cost cutting. Although I would add that cost cutting was very expensive. Okay, guess that makes sense. Let's read on. Wells Fargo shares fell Friday even after fourth quarter profit rose from a year ago as the bank warned that net interest income for 2024 could come in significantly lower year over year. Earnings were lowered by $1.9 billion or 40 cents a share. That's based on the FDIC special assessment of $969 million. There's that FDIC charge again. Wells Fargo also said that they were going to take $1.9 billion. That was the special assessment from the FDIC, and then a $969 million charge associated with severance expenses. That's payouts to all the people that they laid off last year. Wells Fargo cut a lot of people, and they're saying they're going to cut even more this year. So that is the expense of cost cutting, that $969 million in severance. As we look forward, our business performance remains sensitive to interest rates and the health of the U.S. economy, but we are confident that the actions we're taking will drive stronger returns over the cycle. That's according to their CEO. We are closely monitoring credit, and while we see modest deterioration, it remains consistent with our expectations. So those are a little bit of words of caution from Wells Fargo there, saying we are sensitive to interest rates. We're sensitive to the health of the economy. We're starting to see some problems with consumer credit, but don't worry, it's all within our models. We've prepared for this, is what they're saying. Wells Fargo said net interest income fell 5% from a year ago to $12.78 billion and warned that that figure could come in 7% to 9% lower for the year from $52.4 billion in 2023. The decline in net interest income was due to lower deposit and loan balances, but offset slightly by higher interest rates. Provisions for credit losses rose 34% to $1.28 billion. That's up from $957 million a year ago, as allowance for credit losses rose for credit card and commercial real estate loans. Watch that CRE. Wells Fargo said that was partially offset by lower allowances for auto loans. That's interesting. Lower allowances for auto loans. Everything I've read has said that auto loans are getting worse and worse and worse, not better. And Wells Fargo is saying that it's getting better here. That seems a little arbitrary to me. Everything I've read does not support that. Everything I've read said provisions for auto loans should be getting worse. It's possible that the provisions for credit card and CRE were so bad that they're like, just make the auto one smaller, just so our numbers aren't totally destroyed by this. But Wells Fargo is setting aside a lot of money for people not paying back their loans. Watch out for that one. Wells Fargo stock down 2.3% ahead of the opening bell at the moment. And what else we got here? Citi swings to a $1.8 billion loss on a slew of charges. We knew this loss was coming, but it was actually a little bit less than expected. Citigroup on Friday reported a $1.8 billion loss for the fourth quarter as it recorded charges to refill government deposit insurance fund and carry out sweeping internal reorganization. That is the horribly named Project Bora Bora that's going on at Citigroup, as CEO Jane Fraser, who said these results were very disappointing, but expects this year to be a turning point. She is leading this charge. Some important things here. Where's the number on the charge? Oh, I had it highlighted and I lost it. Anyways, they had a big charge from the FDIC. Also a big charge for severance because they're laying off a lot of people. They're getting out of a lot of businesses. So Citigroup taking that $1.8 billion loss, this was a big hit to them, but it wasn't as big as the market was fearing. So even though they posted the worst results from the whole group, their stock is actually up this morning by 0.63%, trading at 52.41. So guys, if I had to rate these bank earnings, I would probably give them a C+ here. JP Morgan's earnings were fantastic, insultingly so, because they are just getting so rich and so much better based on everything that went on last year. Bank of America's were pretty bad. That LIBOR SOFR charge, keep an eye on that one. I don't know what's up with that LIBOR SOFR charge. That's something to watch out for because none of the other banks saw that. Does that mean it hasn't hit the other banks yet, or that the other banks just did better in that department? Keep an eye on that one. Those unrealized losses getting smaller at Bank of America, that's a big one because remember, as interest rates have fallen since the end of October, the problems at our banks got a little bit better, at least the problems that failed banks in March, because while this has been happening, commercial real estate has been taking a dump and consumer credit cards have been taking a dump. See also those higher credit loss provisions at a lot of the banks. So the banks are not out of the woods, but it's a different problem than we had back in March now. And Citigroup was just terrible, but not as terrible as everybody was affected. So overall, I'm going to give a C+ to these bank earnings. It would probably be a C-, even a D if it wasn't for JP Morgan here. But the market is really, really liking that PPI this morning. I just want to say thank you very much to Stephen Say, who says MSNBC and Bloomberg Ask soft questions to guests. No hard-hitting questions or skeptic, i.e. permanent job losses, isn't a problem in their pockets. Look, MSNBC, Bloomberg, we'll expand that to say CNBC, Wall Street Journal. These guys make their money from the people who need this bubble to keep going. So they are representative of they. Our media has become so big and so corporatized, and their interests are so conflicted that they do not benefit from telling us the truth, from speaking the reality of what's going on. They don't benefit by holding the feet of these bank CEOs and these government muckety mucks who mess with the statistics. They don't benefit from telling the truth or from digging and from asking prying questions. They're actually hurt by that because they're afraid of losing access to these individuals. Oh, if I give Jamie Dimon a hard time, maybe he won't come on my show 3 months from now, so I better lob softballs at him so he likes me. The media is failing in its role as watchdog of the powerful, all right? And that's why shows like this and channels on YouTube and independent journalists are rising to fill that hole right now because they're just not doing it. Now, they'll call us doomers and they'll say, don't get your advice from Twitter randos and stuff like that. But, all these things that YouTubers, that social media people are doing, digging into these frauds and exposing them and naming them, it's stuff the press used to do. Now, there are still some good names in the press. There are still some people that are doing that important work, but they are very few, and they're not the ones who are getting their own primetime shows. The ones who toe the party line and play ball, they get the primetime shows. So, it's the incentive structure and the conflict of interest in the media that I think is the problem. And yes, absolutely, Steve, in their pockets. Well said, sir. Thank you for the support of the channel. Thank you for Joey Sox, who says, thoughts on mining stocks. I want to refer you, Joey, to an article that Bob Coleman at Profits Plus ID just wrote. He's not, I can't recall off the top of his head his Twitter handle, but his name is Bob Coleman. He's a good guy. He's really smart. And he just did an article about some strange things going on in the metal space right now. We're seeing premiums fall. Even though metal prices are rising, a lot of people are selling their retail stuff. A lot of people who own stuff like this, right, the small retail bars, they're selling this stuff because inflation is killing people, right? They're not selling it because they want to, because prices are at an all-time high. They're selling it because they need money to pay their bills. And so what you have is dealers are flush with retail material, with retail bars, but they're not buying the big stuff. There's actually a shortage. Lease rates are rising for the big 1,000-ounce bars. Miners are not doing so great here in this environment. And if oil prices are rising, they're not going to do so great. It's going to be even worse because energy is a big cost for the miners. So, Joey, I think it's time to bring Bob on the show and pick his brain about this thing going on with leasing rates for metal, with the premiums plunging, even though prices are higher, and what that might mean for the miners. It's an excellent question, but the miners they've had a pretty good couple of months, but something tells me there's a rough road ahead for the miners. Be careful in those mining stocks, guys, especially the junior miners. Watch out for those. Thank you, Joey Sox. Appreciate the super chat, the support of the channel. And thank you to Joey. Oh, I'm going to have a hard time with that one. Man, you guys, Joey Geis, or is it more like a Gis? Joey Gis, 10-2 uninverting. Well, right now, the 10-2, let me bring that back up. We have got the 2 has now down 11 basis points this morning, and the 10 is down 2. So the 10's down a little bit. The 2's down much more. They are uninverting right now. I'm not really sure what that means. Why the 2? The 2 is the inflection point today. Yeah, it is uninverting, but it's weird. There's a lot of pressure on the 2, and you don't have that pressure on the longer end, and you don't have that pressure on the shorter end. It's right at the 2. Some of you guys who are a little more fluent in the bond market maybe could weigh in the comments and help me out with that one. Why is the 2 in particular plunging right now? Was today an auction or something? I'll be honest with you. I'm not sure what exactly is going on there. Why that particular duration is really getting hit right now. But yields are falling, guys. Yields are falling means prices are rising. So people are buying bonds this morning. My guess this has a little bit to do with the PPI, and people just like that. And so they are piling into bonds. I wish I had a better answer for you, Joe, but the bond market has me scratching my head this morning. Thank you very much, sir, for the super chat and the support of the channel. And thank you, everybody, for having your coffee with the Melonheads this morning. Just a reminder, I will be back this afternoon at 3:15 p.m. Eastern Time for my weekly wrap-up live stream. And there's been a lot this week, so we got a lot to wrap up. Hope to see you guys there. Thank you, everyone, for the super chats. Thank you to my Patreon supporters for everything you guys do for the channel. Links down below to all that good stuff, should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Until next time, live small and dream big.